Dunzo has come out with its financial quarterly earnings results.
Annual results
Annual
for
results.
FY23 in this case.
FY23 annual results, the annual results, not just the quarterly one, the annual results. And guess what has happened? Its losses have increased 288%, nearly 300%, to over 1,800 crore rupees. The only silver lining in this scheme of things is the fact that revenues too have witnessed an over 300% increase. Kartik, how do we put these numbers in perspective?
I think let's stay on these numbers, Krishna. Right. I see absolutely no silver lining here. I see no silver lining. Your revenues, while the percentage value is high, 319%, that's a four-fold increase in revenues. But look at the quantum. Revenues have jumped just from about 54 crore rupees to about 226 crore rupees.
Okay.
On a total revenue of 226 crore rupees, how does any company justify expenses of 2,000 crore rupees? That is almost 9 times or so the expenses you're making on your revenue. How do you justify that? And look at the losses. The losses have also grown, obviously, from 464 odd crore rupees to about 1,800 crore rupees. Now, this revenue increase obviously could be linked to the massive ad spend that Dunzo had undertaken during IPL. Do you know how much Dunzo burnt during the IPL, Krishna? 310 crore rupees in advertising.
And they made 220 out of it?
And they made a total revenue of 226, which was already on a base of about 54 crore rupees. So what is the delta? And this delta is actually annualized for FY23. It is not just for the IPL period of of FY23. So 310 crore rupees undertaken on advertising on IPL alone. But look at the other problems which are plaguing Dunzo right now. And in fact, before we come to that, Krishna, I think it will be interesting to put these numbers also in context.
Right.
Let's compare it to the peers of Dunzo. Companies like Blinkit, companies like Zepto, companies like Swiggy Instamart, which is yet to release its numbers.
Individual numbers, they always release
numbers. Exactly. So let's move on to those graphics if we can. And you'll see that, perhaps the only silver lining happens to be Zepto and nobody else. So here we have it. So Dunzo revenue we spoke about 54 to 226, right?
Yes.
That's a 318% growth. Blinkit in the same time period has registered a lower growth rate, but look at the gap up difference between the total revenue, 724, right? And look at Zepto, 2,000 crore rupees from a base of 141 crore rupees. Now, Zepto was one of the only unicorns that we saw in calendar year 2023. Right. Now, not just on the back of that, overall business operations, these are operating numbers. These are not valuations. These are operating revenue that a company like Zepto has gone 1,335% jump. Compare this to Swiggy Instamart. Swiggy is yet to file its financials for FY23.
But it's going to be definitely more than that.
Exactly. I mean, the last year revenue at 2023 is just 1 crore lower than Zepto's this year revenue.
Swiggy seems to be ahead of the year in question. In 2022, they delivered 2023 revenues.
Exactly. But the point still is, how many of them are actually making profits? We can't say that Zepto is making profits, or Blinkit has, I think, just about broken even operationally on profits. I'll have to check that data. But I think when Zomato filed its filings, we saw that Blinkit was not, one of the red flags, so to speak. I don't know if the arrow was red or green.
But in fact, it showed a growth in terms of business for Zomato.
Absolutely. And Swiggy Instamart, I think we've known for a while, Swiggy's food business has turned profitable in the month of July or August. The statement that came from Swiggy was that even its quick commerce business, which is Instamart, is likely to turn profit in a few weeks from then. So I have a feeling that it would have turned operationally profitable. But there are more challenges at Dunzo. What are these challenges, Krishna? I think challenge number one is a tremendous markdown in valuation at a time when it wants to raise about $25 to $30 million as additional fresh funding to take care of operational expenses. I mean, imagine you want to raise capital to take care of day-to-day running of the business. Salaries have not been paid. Some reports indicate from as long ago as July this year to some reports now suggesting that the July-August arrears were paid in September, but September onwards the company is yet to pay salary to its employees. We've seen about 30% of the total Dunzo workforce getting sacked. So there are these challenges. Now, who owns Dunzo is another question. Almost half of the company is actually owned by Reliance Retail through its investments in the company, which is at about 26 odd %. and Google, which owns about 19%, in addition to Lightbox and Bloom Ventures and some other investors. But almost half the company is held by these behemoths called Reliance and Google. And now fresh funding that may possibly get infused, which has also been long delayed, is going to come in at a lower valuation, perhaps in the same ratio as the existing investors have already invested in the company. So there are challenges, and I think the fundamental question is it time for quick commerce in India to finally consolidate? I mean, you have some dark stores which are not doing great business. You're yet to do your partner tie-ups. ONDC is yet to sort of, come in full bore, disrupt the market. I think there is time to cut your losses by riding on perhaps to an ONDC sort of a network, so you don't have to take care of all logistics costs and there's somebody else who partners that cost with you. And in addition to that, some sort of a consolidation where those who happen to be in business also happen to make money.
Right. It's interesting you say this now, Kartik, because if we had the same conversation 6 months ago or a year ago, there was a big question mark on whether quick commerce as a business was meant to be profitable, because it looked as if there was absolutely no, it was going to be very difficult for these people to have a genuinely profitable business. But look how the tide has turned in just about a year's time.
Absolutely, Krishna. And I think even back then, it was understandable that if you have a supplementary business, which in the case of Zomato and Swiggy, they do, if one business is able to offset the growth in another business, it makes economic sense. Maybe not at the unit level, but at a macro level, if you have two businesses and one vertical is creating supernormal profits which can offset growth for a foreseeable future, for a short runway, for the other business, it makes sense. But if you're running a standalone quick commerce business, it's better that you sell out, consolidate, cut your losses, definitely cut your expenses to begin with. I mean, stop these advertisements and stop burning investor money on, on advertising which is not raking in the revenue in the right ratio. And in addition to that, consolidate. Find somebody who's going to buy you out. You have some customers, you have some delivery agents, you have stores, you have warehouses. Consolidate that and exit while you still can.
Right. And again, I go back to the same question on whether quick commerce still has value in terms of unit economics. Does it make sense in terms of unit economics?
Standalone with the 9-minute, 10-minute, 15-minute, 20-minute deliveries, I doubt it. Which is why perhaps Dunzo is also looking at Dunzo Daily right now, which could compete with the likes of, let's say, a Big Basket or a Milk Basket that is not instant delivery, or an Amazon Fresh for that matter. It's not an instant delivery. There is a time schedule to a delivery. It could be next day delivery. But the point is to now, from this loss-making unit, create another business model and burn more cash in making that popular. I don't know where this tide is going to ever turn.
Okay. I'm only asking because how is Zepto doing it? How are other players being able to do it? Because clearly there is not one trend. There seems to be a clear problem with Dunzo and the amount it's spending and the amount it's able to make that money back. You can't say the same thing about Zepto.
For Zepto, you're right. I think Zepto is one good exception to this rule, and Zepto has held on fine. Even Grofers, for that matter, before it was bought over by Zomato and rebranded as Blinkit, was making similar losses and facing similar challenges as Dunzo. So I think Zepto, you're right, seems to be, at least right now, one sort of beacon of hope for quick commerce deliveries and for this whole single platform, single business model to work. But again, the numbers we are looking at for Zepto are only revenue numbers. We are not looking at profitability numbers. And I think I may be wrong to stick my neck out and say, but I doubt Zepto is profitable, and I doubt the story at a unit economics level for Zepto is any different from Dunzo.
Okay. You're just like dampening the spirit of all of us who've been enjoying these 9-minute deliveries and hoping that that's a really good business and keeps continuing. And we have more and more options.
No, I'm all in favor of it, Krishna. Don't get me wrong. But I think there is need for consolidation. There is need for quick commerce to be part of the larger e-commerce story where some losses here can be offset by some profits there.
Okay.